Hello, everyone, and welcome that are joining. We're going to give it just a couple more minutes, as I know there's a lot of people that are trying to get in right now and probably trying to overcome the verification hurdle. So we are just going to hang out for a second to allow everyone to get in before Heather is going to start speaking to us. To everyone that is in here already, we do have the question and answer enabled. So if you have a question as we start talking, please put your question in there. Karen is going to be monitoring the questions. She's going to be responding throughout if she can. If she cannot, then we'll hold those questions for me. I will be grabbing those periodically or at the end. So feel free to ask questions as we go along. You can also raise your hand as we go along as well. And that indicates that maybe you have a question that you actually want to say out loud. And we should be able to unmute you hopefully at the end if we have a couple minutes in order to be able to answer those questions as well. So we will get started here in just a couple minutes. Okay, it looks like we've got several more people coming in, but we are going to go ahead and get started because in pure Christy webinar fashion, I have so much to talk about and we are going to take the entire hour to do so. So hopefully everybody is getting in safely. As I mentioned before, the question and answer is open. For this, please drop your questions. Karen will be answering those throughout as she is able. Otherwise, we will be holding them to the end. Once there is an answer to a question, then everybody will be able to see the question as well as the answer popped in there. So we realize some of you may have that exact same question, so we may not answer everyone directly, just making sure that everyone gets the information from that standpoint. We have Heather with us today. She is with OSDC. She's going to talk in just a moment. And also, as I mentioned, we have Karen Wilson. She is with SBC Consulting. Heather is going to go ahead and kick off today. This is a unique webinar because they are a collaborating marketer. So I know some of you here today are here because of OSDC. So we'll let her go ahead and talk about their wonderful organization.
Thanks, Christy. Welcome, everybody. We're so happy to have you here. Ohio Statewide Development is a CDC under the U.S. Small Business Administration, which means that we're tasked with promoting economic development all across the state of Ohio. And we make it our mission to specifically help small businesses access capital. How do we do that? We work mostly with the SBA 504 program and the Ohio 166 program, and those help small businesses gain financing for commercial real estate and equipment projects with low fixed rates and low down payments. We also offer education and technical assistance workshops like this one. We're so excited to be partnering with SBC and also Accelerate Columbus. If you're interested in what we do or want to learn a little more, I invite you to check out our website. It's osdc.net, and all of our contact information is there. We would be happy to hear from you either by phone or email, talk about your projects and see how we can help you. Thank you all for being here, and I'll pass it back to Christy.
Awesome. Thanks, Heather. And thank you for joining in the fun today. So my name is Christy Dudgeon. I am the president of SBC Consulting. SBC is a contractor with the city of Columbus, particularly for what is called the Accelerate Columbus program, as Heather mentioned. If you're not familiar with Accelerate Columbus, it is an awesome program for small businesses that are based within the city of Columbus limits. And it is well beyond what we're talking about today. There's also groups being led that have to do with marketing as well as AI. And so if you have any questions about that, I invite you to learn more about Accelerate Columbus. I'm also going to talk about how that you can become registered and participate in potentially the one-on-one consulting that you might also be eligible for if you are a City of Columbus based business. I'm also excited to announce, as part of this collaboration with OSDC, that they are offering scholarships as well for those of you that may not be within the City of Columbus limits, so that you can also take advantage of that one-on-one consulting that is available from a financial standpoint. So we are going to go through a ton of information. As I mentioned, I'm going to drop a couple polls as long as everything works well with my webinar, so that you guys can provide a little bit of feedback as we go along. It is going to be a ton of information. It's designed to give you a very high level overview of a lot of this. And as I mentioned before, if you need additional help, there are potentially programs either for through Accelerate Columbus or through those scholarships that OSDC has available, so that you can get that next level help directly that maybe your individual business needs. So, what does it really mean to be financially ready? That's what we're talking about today. Is your business, are you as the owner financially ready? So, that means that you know your numbers, your finances are organized and up to date. You can manage your cash with intention, and you can confidently explain your business financially. Now, that is a big list, and it's sometimes a very scary list, especially if you are new in small business. However, it's not about perfection, it's about clarity and consistency when we're talking about financially ready. Also, all businesses start at the exact same place, right? When we're starting our business, we've got that zero financially ready. We've got to build in these systems. We have to build in this knowledge and this information. I just was having a meeting with a accountant, financial person, in her background, very diverse background in finance. However, she's now in business and doing it for herself. And she was talking about the hurdles that she even has to overcome in order to be financially ready for her business. So if I asked you to send me your profit and loss, your P&L, and a balance sheet right now, what would your answer be? So this is going to be a poll. If I can grab it real quick and drop it in there. Um, see if we can launch it so you guys can actually, hopefully it pops up and you guys can actually provide an answer to that. So if I were to ask you that, you would say, I've got those. How do I send them to you? I have them, but they aren't correct. I do hear that one a lot. Also, can I get back to you in a week, a month, a year? Like, I'm not real sure. I don't really have them, and now I have to go figure out how to do this right. Or what are those? So that just gives us kind of baseline of where everybody's at. Thank you to those of you that are answering. So we're going to talk about the 4 keys of financial readiness today. And so key number 1 is to have a consistent financial management system. Now, a financial management system can look very different depending on where your business is, what you're utilizing in order to manage those finances, also who within your team, whether it be you, you have an employee within your team, you've hired a bookkeeper or a CPA, an accountant, someone that is managing it from that standpoint of they're the ones doing the transactional part, or maybe they're doing the analysis part, whether you're using software, right? So this is a huge topic and an entire webinar in itself, even a multi-webinar. But the goal to this, or the key to being financially ready or financially prepared, is to have some kind of consistent financial management system. So you probably heard me say a couple key things there. It is the system itself, so whether it's a piece of paper, some software, And it's also the people that are responsible for it, right? So if it's you, the employee, you've got that third party bookkeeper or an accountant. So, what this does for your business when you have this in place is you stop guessing and start knowing. That's the key. You can also make different decisions with confidence because you have numbers that you can trust and they're clear. You avoid surprises, especially with cash and taxes, which we're going to talk about a little bit today. And you can clearly see what's working and what's not. Those are very important things to be able to see. And that's tough if you don't have a system in place and maybe you're just handing over your information to a tax accountant at the end of the year and one time you actually see your numbers. You can make some decisions based off of that, right? But it's not what I would call consistent because it's just a one time year a year thing. You also become more prepared for opportunities and also challenges that might be coming your way. Obviously, with the economy and things recently, especially since 2020, things are shifting rapidly. There's a lot of changes that are happening in the marketplace, inflation, employment, all these numbers affect your business. And so you want to be able to be prepared for those opportunities that come your way, as well as those challenges. And having some kind, as I mentioned before, some kind of financial system in place is a key to that success. And so I mentioned before that can look a lot different depending on where your business is and also where your knowledge or aptitude as far as what financial management is as a business owner. So this could be a piece of paper that you're literally writing things out. This could be bank statements that you're looking at and you're kind of lumping things into groups. Unfortunately, this could be a shoebox with some receipts in it that you're passing over to someone, right? This could be software, such as Intuit QuickBooks, which I talked about. This could be an Excel spreadsheet. There's Google Docs out there when you're first starting out that help you manage it. And you could also partner someone like SBC Consulting that can help you with bookkeeping and financial advisory as well. So there's lots of systems out there. And the point being, choose one and be consistent with it. So every day we see small businesses that don't quite have that consistency, or maybe they have something like QuickBooks, but they didn't really know how to set it up in the first place, or they're not really sure how to use it once they're in there. So the software itself is pretty easy, but understanding those workflows and that bookkeeping aspect of it can be really confusing unless you've got a little help. So that's the cool thing about Accelerate Columbus is that it's out there to be able to help you understand this and to be able to have visibility to those numbers a little bit better. So, the basics of a strong financial management system, though, whether or not you're using a piece of paper or you have something as advanced as QuickBooks, or even if you have that third party bookkeeper that's doing it for you, is that everybody needs to have what's called a chart of accounts that's simple and it's clear that you can understand it. And basically, what a chart of accounts is how things get organized. So, you need to be able to see your income correctly, see your expenses correctly, your assets, your liabilities, and your equity. So those are the main 5 accounts that are within a chart of accounts. After that, you have a bunch of accounts within those. You can get really confusing and really out of whack pretty quick with your chart of accounts if you don't have things kind of in the right place. So being able to have that support to do that is super helpful. Then you need to organize your transactions or categorize them, it's called, regularly. So this means you're taking all of those transactions and you're putting them into a bucket so that you know if it's income, if it's a particular type of expense, an asset, a liability, or an equity. And so a lot of businesses will get to this step right here where they start to put them in buckets. The next thing that needs to happen is that your accounts need to be reconciled monthly. And basically, what that means is you're taking a statement, whether it be a loan statement or a bank statement, and you're making sure that the numbers all match. And so we've got the numbers from the statement that are correct, and then we've got our financial reports, and those numbers match each other. And so if there's any extra things that happen along the way during the month, we need to make sure that we get those out of there or that we resolve those. So we don't want our account numbers to be higher than they really are or lower than they really are, because then our financial statements won't be correct. So in order to have our accurate, up to date reports at the very bottom, we have to do that process. So we've got to have our chart of accounts that is simple and accurate. then we have to categorize everything, then we have to reconcile. And once we've done those three every single month, we can look at those financial reports and say, okay, these are accurate and up to date, at least to the best of our ability, but we probably want someone to check them. So, organizing chart of accounts, tracking and categorizing those transactions, verifying reconciled accounts, and then understanding those financial reports is that key to financial management system. So that leads us into our key number 2, which is knowing our financial reports. And we're going to spend a little bit of time here because financial reports are that important. If you are a business owner, you might not be doing step 1 of that financial management, right? Most of us did not start our business in order to be our financial manager. We probably did it because we knew the thing, or we wanted to do the thing that we are doing in business, and then we realized we've got all these other things that we have to do because now we own a business. Finances being one that's extremely important and definitely not an afterthought. But what we do need to have are these reports. So even if we are not the person that is organizing that information, reconciling, and then creating those reports, we do as a business owner need to know everything that's on these reports, how it got there, and then what we can do with it. So it's not just numbers on paper, these are extremely powerful. So the three main reports that we're going to talk about today are the profit and loss, balance sheet, and cash flows. The profit and loss is also called income statement, so you'll see that interchangeably through here. But what these three reports are telling us is the profit and loss is saying, are you making money? We need to know that, right? A balance sheet is what do we own? These are our assets. What do we own? And what do we owe? Those are our liabilities. We'll see that on the balance sheet. And then cash flow is really telling us, do I have money? Notice in here, none of this I said check our bank account, right? So our bank account's going to give us a value that's in there. However, we're going to get more powerful information out of these three reports that we obviously cannot see directly from our bank account. So these reports are a standardized view. If you're using something like QuickBooks for your day-to-day transactional maintenance, these reports you can, as a click of a button, you can generate them. If you're using a spreadsheet, sometimes it's a little more difficult. You've got to do some manual process there, but it's still possible for you to generate these reports. It helps you track performance, and it also helps you determine if you're loan eligible. So this is one of those keys to being financially ready, is these financial statements. So in the profit and loss, what does it show us? How much money our business made. We're going to see that really clearly at the very bottom, or how much money we didn't make. How much money it spent, and whether we are profitable or we have that loss. So that's what I was talking about down there at the bottom. How a profit and loss report works is that it is our income and expenses for our company over a period of time. So it's a pretty cool report because we can look at it as little as today if we want to. Do we want to know what our income and expenses and if we were profitable today? We'll see that. Do we want to know for the week? Do we want to see it for the month, the year, last year, prior years, right? And then we can do comparisons year over year, month over month, day over day, week over week. Once you've been in business for multiple years, it's really cool to be able to say, on this day in history, were we performing the same or better, right? And so that's how we know what our goals look like. And if we're growing the business or the business is down, right? And so obviously in a year like 2020, we saw a lot of really crazy things happen in a lot of small businesses. But this is a powerful report to help you manage a business from an income and expense standpoint, because that's all we see on this report. So as I mentioned, income, also known as revenue, that's one of those interchanges. This is money that we've earned by doing business. So this is our services, our products, contracts, events, subscriptions, grants, if applicable. Some grants are considered to be revenue, some are not. So it's important to know what grant you've received there. Expenses, this is money that you spend to operate, and it can include those direct expenses, also known as cost of good or materials. And also our indirect expenses, such as payroll, rent, marketing, software, insurance, utilities, professional services. Those indirect expenses are just the cost of doing business, whether we make a penny or not. So if you're a business startup, you're going to see a lot of expenses happening and maybe not a lot of revenue, right? And so most of those are going to be indirect expenses. Once you're rolling in business, you should definitely have direct expenses outlined. Those are considered to be direct, or those cost of goods sold, because they directly influence the outcome of the sale. You wouldn't have had those expenses otherwise. So if you're in manufacturing or something like that, it's the raw materials that you're purchasing to then create the good that gets sold. If you're reselling products like a retailer, then it's purchasing that product and reselling it. There's quite a few little categories that cost of goods sold can fall under. So, why this report is important, it tells us if we're making money, also any changes that we have in expenses. So, if we can visualize everything that's happening from an income and expense standpoint, as a business owner, we can start making decisions on what gets, how we can control some of those costs, right? Potentially. Also, we can see what our most successful products are depending on how we've got this set up. And most importantly, at the bottom of it, we're going to know if we've got a profit or loss, right? Are we making money or are we not making money at the end of the day? This is what a basic template then looks like for a profit and loss if you've not seen one of them. The income is going to be at the top, the expenses are all going to be in the middle, and then that profit and loss from the business down there at the bottom. So, what do we review? All right, we've got this piece of paper in front of me with a bunch of numbers on it, and I'm not really sure what I'm supposed to be doing once I review it. So, does the income look accurate? And some of these are a gut, instinct because you are the owner, right? So you probably have a pretty good idea how much money the business should have made. The expenses, you're not always sure from day to day, especially if it's a subscription. Those seems to add up really quickly with all these different subscriptions that are out there. But you want to make sure that any major expenses make sense and that they should be on there. Or maybe are they in the wrong place, right? So sometimes an expense is actually an asset and should have been on the balance sheet as opposed to the profit and loss. And so you want to look at all those accounts and make sure things are correct. Also, are there any unusual items, just like I said, or missing items? So, a common thing that I'll see on a profit and loss is a loan payment. A loan payment is not an expense, it's the interest for that loan that's the actual expense. The loan payment goes towards the loan on the balance sheet. So, that would be in the wrong spot. That's one of those things. And that could be an error in categorization, right? And so, we might also have accidentally called an income and account an expense account, and we see it in our expenses. And so we've just got that in the wrong place with our chart of accounts. We need to move some things around. So this report answers, as I said again, am I making money? And so what else can we learn from this though, other than just visually seeing numbers on paper and if things are in the right place? So this is where we actually learn what our margins are. This is our gross margin, our profit margin. We're going to be able to see those and do a little calculation to get a percentage. Different trends. So as I mentioned before, you can look at this report today, the week, the month, the year to date, last year. So you can see different trends from month to month or week to week, pricing problems that you may have. So maybe once you've looked at your income and now you actually have your cost of goods sold in there correctly, you can see if your percentage from a gross margin standpoint is accurate, and now you've got pricing problems potentially. Those will show up on here. Different growth patterns, and then also those cost control opportunities now that we can see our expenses all laid out. And then the balance sheet. So profit and loss is that first report. Balance sheet, even if I work with businesses, sometimes they'll get their profit and loss accurate, but they'll say, oh, that balance sheet, I don't understand it, right? So there's a lot of things that can happen on a balance sheet as far as your business is. And these are where those reconciliation of those accounts really come into play because the balances are all on here on a balance sheet. But that's not why it's called a balance sheet. It's actually called a balance sheet because there is an equation, and you can see that in the middle of my little napkin doodle over there, that is assets equals liabilities plus equity. So this always has to be in balance from that equation. And if you like math, you can switch it around and run it a bunch of different ways, but it's always going to equal itself. And so our assets are what the business owns, our liabilities are what the business owes, and then equity is actually considered what it is, what the value of the business is to the owner. So this is where a lot of owners are actually going to pay themselves We're not considered to be an expense on our profit and loss. This is LLC, specifically sole proprietor partnership. We can use owner's equity to pay ourselves, and that does not affect the profitability of the business that way. That's the more accurate way to do it. The balance sheet is a snapshot of our business financial position on one specific day. So, where the profit and loss, we could look at it by day, by month, by week, by year. The balance sheet is on a particular day. So, we're seeing all those balances of those accounts yesterday, today, whatever that may be. And so, this report is the most accurate when you have reconciled the month prior, right? And so, we look at it the month prior. We know that we've matched those up to all of our statements and those balances are correct. We're going to see issues with liabilities that potentially come in here if we've got payroll liabilities, sales tax liabilities, any of our loan balances. Maybe we didn't put our interest in there or we accidentally had our payments in the wrong spot. That's why this is a very powerful report. Also, this report is extremely powerful when it comes to lending and potentially with loans. So there's a ton of ratios that your lender is actually going to run from this in order to get more visibility into the financial health of your business. If these are not accurate, this can lead to misleading financial decisions, right? So maybe you think you have more money than you do. Maybe you think you owe less on that loan than you actually do. Loan or grant application problems. That's a big one, right? So if they start to analyze your bank statements and things like that, and things just aren't matching up, you might immediately get okay, go back and fix this, not right now, before we can move forward, right, with the underwriting process. So it can definitely delay a loan application. Cash flow surprises. We're going to talk a lot about cash flow here in a second. We don't like cash flow surprises, right? That's when we run out of money, although we thought we had it. So we don't want those cash flow surprises. And also difficulty understanding the true business value. So if you are interested in selling your business, the balance sheet is going to be extremely important as part of that due diligence process when someone's buying your business, or vice versa. If you're buying a business, it's extremely important that those financial statements are accurate so that you can truly value that business and determine what you're going to buy that business for. So accurate books start with reconciled accounts. Very, very important. So that's back to this key number one, and that's that financial management. Why it matters, negative asset balances. This is what common red flags if you're looking at it yourself. You want to make sure that the asset balances aren't negative. Assets are something that you own and they're always going to be positive, right? Unless for some reason you've overdrawn your bank account and it might actually show negative. That's that cash flow problem, right? Negative liability balances. So liabilities are also going to be positive. So these are your credit cards, your loans, any of those withholdings that we talked about, payroll, or sales tax. That's important that those are positive as well. Incorrect account detail types. We see this all the time, and that just is usually a setup issue with your chart of account. And that just means that you've got the wrong account type for what you wanted it to be. So maybe you called it an asset and it's really a liability. So it's going to show up on the report in the wrong place. Very old receivables. If you invoice people and you're waiting for them to pay, or maybe you've got the workflow incorrect in something like QuickBooks and you didn't automatically put those payments back towards that invoice incorrectly, you're going to see this show up on your balance sheet because receivables are actually considered an asset. And they're very important from a lending aspect because you're anticipating that you're going to collect that money at some point. So if it's uncollectible money, then that's a red flag or a big error. Also, payables seem incorrect. So these are your bills. This is when you owe somebody, this is going to show up as a liability. You want to make sure that that balance of what your liability actually is correct, right? We don't want these huge liability balances when we don't really owe that much because that doesn't make you look quite as good from a lending standpoint. Questionable withholding accounts, large unexplained equity balances. This is if you've had a big infusion from a investment from an owner standpoint, or maybe a owner's draw, right? And it's showing a huge amount of money that's not realistic. It could just be an error. Loan balances that don't change. Loan balances are always changing, right? We've always got interest that's coming in. We're always making payments. So those balances should forever be changing. And also missing accounts. So if you have assets, you need to have them on your balance sheet. You need to have those accounted for as well as liabilities. They're extremely important. These ratios that I mentioned before. So what these ratios are helping understand or know is business pay its short-term bills. So that's that you can actually see that from your balance sheet if it's accurate. Is the business carrying too much debt? So not just from a liability standpoint, but do we have assets to cover it? It's called a debt ratio. This is one of those ratios that a lender is going to look at. And is the owner building equity in the business? So you're going to be able to see if you've got investments that are coming in as well as those draws. And then within equity is something called retained earnings, which is your profitability over time. So that's a number that's going to continue, if you're profitable, going to continue to increase, but it also may decrease, right, in those years that we're not profitable. But we'll be able to see if you're building that equity and it's directly from that balance sheet. So these financial ratios help detect financial stress early. They understand your borrowing capacity. They help you prepare for those loans and grants and make those better expansion decisions. So when it's time to grow, I was just having a conversation with another business owner, and she's like, "I want to grow, I want to grow." And so we all say that, but there is a lot that can go into making that decision as far as how we make those expansion decisions, and then also building that long-term financial stability, which is a place we all want to get to at some point. Key number three then is cash flow management. So I mentioned this one. We also could consider this the third most important, if not most important, financial report. So this is one of those reports that are lumped in there. There is, from a financial management standpoint, information that you need to have in order to be able to create this cash flow report. And so, we're going to go through what that looks like and how important it is. So, back to our very first poll we had from a financial statement confidence, it looks like we're pretty mixed as far as the group is. So, we've got some people that have those ready and they can send them, all the way to those of you that are probably really listening into what I'm talking about right now, because I just talked about that profit and loss and balance sheet and how we obtain those or use those. So let me now drop this second poll in here about cash flow. So this is a common item that I hear a lot, and it is, um, well, it looks like my poll is still being shared for the moment. Hang on, let me stop sharing those results and then launch cash flow. So you can tell me if that's a yes, no, or not sure. But we do see this a lot, especially for businesses that don't necessarily review these reports until maybe it's tax time. And so they're going to see that bottom line and they're going to say, oh my gosh, there is no way I had that much profit this year because I have zero cash in the bank, or I feel like I never have any money. So it is pretty common for a business to be profitable on paper. So we're just looking at profit and loss with that, right? But to also be short on cash. And so we need something called the cash flow statement, which we're going to talk about next, in order to help us understand why that's happening, and also how to control it. So, as I mentioned before, the last thing we want to do is have bills that we need to pay and we don't have the cash in our bank account to pay it. And so, just looking at our bank account is not really visibility into how our business is functioning. And so cash flow really tells us if our business can survive. It's actual money coming in, it's actual money going out, it's timing of the cash movement, which is extremely important. The timing is what gets us. So cash flow planning and visibility really helps us prevent panic, because the last thing we want to do is to have to pay payroll and we don't have the money in our bank account to do it. I can speak from experience with this. I was a business owner in 2008, and if any of you know what happened in 2008, basically the entire economy stopped. And so payroll was due. My contractors that I was working with were no longer paying, or the GCs that I was working with. I was in the commercial construction industry, which was a nightmare in 2008. And so lots of things happened within businesses. Now, the greatest cash flow planning, the reason I want to mention that, doesn't necessarily help prevent all of that, right? There are those external factors. However, it can help prevent the ones that we can control. So it's all about timing, right? So when is the money coming in? When is the money expected to go out? And so we can create more of that consistency and stability being the big thing. So a business can be profitable on paper, as I mentioned before, but still struggle financially if the timing of money coming in and going out doesn't line up. And depending on your business, especially the one that I mentioned there before with commercial contracting, you could perform a job today but not be paid for months. And it depends on who you're paying for. So you've front loaded all those material costs, all that labor costs from a business standpoint, but you're not going to expect that flow of money coming in for quite some time. And that can be frustrating. So you need to ask yourself then, will I have enough money or cash to pay my bills? And so the profit and loss is never going to give you that information, right? Where we are looking purely at information that has already happened. That's money we've already spent, money we've already made. And so there's this gap then in that information. And this is the timing of customer payments. So that's that accounts receivable. So what I mentioned in the general contracting world, I've performed the work, I've front loaded all that money, but I'm not getting paid. So that's my AR clock, my accounts receivable clock that's ticking. And that may be 30 days, that may be 60 days, 90 days, depending on whoever it is that you work with. And so bills you owe suppliers, so these are accounts payable, not just suppliers, but these could be utility bills, right? Those subscriptions that I was talking about that are coming out every single month. There might be some on the 1st, the 5th, the 15th, right? So there's different timing throughout the month. Loan principal payments, big one, right? So when are those loan payments due? When are credit card payments due? If I'm using credit cards to help finance some of this. Equipment purchases, how do I know that I can buy a piece of equipment, right? Am I going to fund that internally? Do I need another loan to do that? What would that loan payment look like from a cash flow standpoint? Owner draws. When am I paying myself, right? And how am I paying myself, which we all should be doing. And we should be able to do that much easier if we have a good cash flow system in place, as well as inventory purchases. For the businesses that are in the retail world, right, we might be stocking up here in the next few months in order to push to the end of the year, buying inventory when it's cheaper as opposed to within season. And being able to make those decisions, we have to have that visibility to cash because we're probably going to be holding that for a little bit until we're actually going to get that return. This is what a standard cash flow statement looks like. So we've got cash flow from our operations. This is income. This is our cost of goods sold, right? Our expected expenses that we're going to have in the month. Now, remember, we're not looking backwards anymore. We're looking forward. And so we have to be able to look at what's upcoming and sometimes make projections because we don't always have that piece of paper in order to help us tell this story. And the more that you do this, the more that you get comfortable with this, the better that you'll be able to plug these numbers into here and to make that decision. As I mentioned before, if you use something like QuickBooks, as long as you are using the workflows, but not, whether you invoice or not, right? Accounts receivable is going to look a little bit different if you're just a sales receipt or people pay when they purchase. And then also, but having that accounts payable clock in there is going to be huge to be able to have that actual cash flow so you can see that from operations. Then we've got cash from investing. So if we've got an asset purchase that's coming up, we can put it in there. If we're selling a piece of equipment or something that's an asset, we want to be able to put that in there. And then also investment income or expenses. So, right, the more that we grow, businesses aren't just generating income from sales, they're also investing in growing that way as well. So you can put that in here. And then we've got cash flow from financing. So are we getting a loan this month, right? Or in the next 30 days that we're going to have income coming in from? Maybe we're one of those businesses that lends money to other people. It happens. I've seen it quite a few times, maybe to other employees that were expecting that to come in or other owners. Maybe we're funding another business that we're starting and our business is loaning money to that other business, whatever it may be. We want to make sure that we have that in here from an income and expense standpoint, and then stock income dividends. And so at the end of it, we need to know what our net cash flow looks like. So we've got that all lined out, which is important, but we also need to know the timing of these things. So first of all, is our cash flow going to be positive, right? And then we need to set up when is that expectation from a month to month or week to week standpoint. So it's about timing, not just about profit. Why it feels tight is that income comes in after the work is done. As I mentioned, bills, payroll, taxes come out before you're paid. One lame payment can throw everything off if you're expecting a big payment from someone. So having a simple 30-day cash flow check, look ahead, not backwards, right? Money coming in, where are those expected items, money going out, and then setting aside for taxes also. And so the key number three, which we're going to get to, is about tax preparation. And then what's left. That helps you guide your decisions. Maybe you can pay for that piece of equipment. Maybe you can buy that extra inventory this month. But that's going to let you guide that decision, and it's going to be based on data as opposed to just intuition when you're looking at the bank account. So this helps reduce those surprises, helps you plan for those expenses, shows problems early, and it gives you a lot more control from a business management standpoint to be able to make those decisions. So it's a if you can see 30 days ahead, that's that magic crystal ball, right? If we can see that far ahead for our business, we can make better business decisions when we can see that far. So this is what a simple cash flow example might look like, and this is that month to month. So this is our expectation of revenue received, our expenses paid, and you can see we've got a net cash change in the negative and the negative. So we're rolling 3 months of business before we've ever got a positive cash flow, right? And then month four, we've got more coming in. So cash flow can swing dramatically, and that's why we need to be able to look ahead and be able to plan for that. And revenue may arrive later, depending on the type of our business. And then, as I mentioned before, we might want to then break that down week by week so we can understand when we can pay bills or when we can pay forward for something. So, week one, we don't have any money coming in. However, we've got payroll, rent, and supplies that are due. Week two, we've got a little bit of cash in, but we've got more cash going out because we've got vendor bills that are due. And we definitely need to take care of our vendors because they take care of us in a pinch, right? And then week three, finally, some customer invoices. We're expecting them to be paid then. And then cash out is happening. So without that planning, that early gap could cause a lot of stress, maybe force us to use our credit cards or even jump into emergency borrowing, which is not a great place to be. Common cash flow pressure points are slow customer payments, large inventory purchases, payroll timing, these things that I've mentioned before. And many businesses that struggle with cash flow are actually profitable. So don't be surprised if that happens to you. Key number three in tax readiness. So, tax readiness is another one of those things that can really hit us from a cash flow standpoint. I hear a lot from small businesses. Well, how do I know how much I'm supposed to pay in taxes? I don't know that number until my accountant gives it to me. You can estimate that. It's a pretty simple thing to estimate. You may estimate high or low, but it's better to have some kind of estimate and guide than rather just not knowing, right? So here's a basic example of planning for taxes. So this is an LLC business that's in the state of Ohio that's based in the city of Columbus, because there's different local taxes that come into play depending on where your business is based, right? So we start with our profit. This business has an annual profit of $50,000. Where do we get our profit from? Bottom line of our profit and loss, right? We can use our prior year profit to help us determine that. We can also be paying attention to our profit and loss throughout the year in order to help us estimate that. But then we want to set aside, and this is a safe estimate, right? And this is going to change depending on where you are, 20 to 30% of what our profit is. Now, remember, that's profit, not our revenue. So if we have $10,000 to $15,000 per year that we're going to owe, then maybe every month, or from a cash flow standpoint, if we're looking at this quarterly, because most estimated taxes are due quarterly, then we can take that kind of that bulk and then divide it up whenever we think that cash flow is right. I do recommend when you're dealing with taxes, no matter what taxes you're dealing with, because I see a lot of small businesses get in trouble with this, whether it's sales tax withholdings or payroll withholdings, even if we're estimating federal, state, and local taxes, that you have a separate bank account that you are putting that money into. If you are one of those owners that really likes to look at your bank account number, I've worked for those, even in multi-million dollar businesses. I would have someone looking at that number in that bank account and making decisions on it, not taking into account that there's withholding money in there that we have zero right to, right? Because we've either withheld it from a sales tax standpoint or a payroll standpoint, or we can't pay our taxes. Also, I've worked in a business that was selling equipment off the front lawn because they couldn't pay their tax for that year. A clear cash flow issues, right? An emergency preparation. Um, they then have to make those really panic decisions, and you shouldn't do that, right? So if you have that separate bank account that you are putting those withholdings in and you're paying things out of there, you're probably less likely to touch that one because you're protecting it. So federal IRS is due quarterly. That's April, June, September, January. State of Ohio follows right along with those federal, and then City of Columbus tends to be quarterly as well, if that's applicable, if you have City of Columbus. And those are from estimated taxes, right? Not everybody is going to owe estimated taxes because it's based on that profitability of your business, but obviously it's our goal as we grow our business that it's going to be profitable. Therefore, taxes are inevitable, and we are going to have to pay those. If you're not sure how to do this for your business, I have a ChatGPT prompt right here. I will share these slides with everyone afterwards so that you can have this. But you can ask ChatGPT and you can take this exact same prompt, plug in your information, and ChatGPT will help you figure out what those estimated taxes should be. So we're not just looking at that cash flow standpoint, right? We're not just looking at our profit and loss to be able to determine income and expenses. We're also looking at things like estimated taxes that might be coming into play. So, key number 4 then to this whole big thing, and the fourth key is funding and financial positioning. Now, there's a lot of slides here. I'm going to fly through them very fast because we've got about 14 minutes left. But if you are seeking any kind of financing in the future, these are all going to be important. Now, the point I want to make here so that you understand that is that part of being financially prepared or financially ready for a loan is not just being ready for the loan, right? These are all things that as you grow in your business and your business grows, that you'll be doing on a regular basis and that you'll be prepared for. And that's why it's pretty powerful to have that management system in place, understand your reports, and also that cash flow management standpoint. So, what kind of things do we need to have outside of that? What are funders then looking for so that we can make sure that we've got all these documents prepared? So banks tend to be, or lenders tend to be evaluating 3 different things. So is this our ability to repay our loan, right? Our financial stability and our credibility and our organization of our business. So getting approved for that loan is really just the first step. So maybe we've worked really hard to get our financial information together for that. However, we need to then take those next steps and make sure that we're ready to repay it. And that's what protects us and our business as we move forward. So, to be loan ready, what does that mean? Lenders are typically looking for a business that demonstrates clear financial records. I've said it maybe 30 times already today. Accurate profit and loss statements, organized bookkeeping in whatever capacity that is, either internal, external, consistent financial reporting. Are you able to look at those reports, understand them, and know those numbers on there? Stable cash flow, so revenue that supports operating expenses, sufficient margins to handle those loan payments, responsible financial management, separating personal and business. This is key. We talk about this a lot in financial management. You don't want your personal life intermingled into your business life. It's called commingling. It's a bad thing. Awareness of current debt obligations, a clear purpose for the loan, so specific plan on how to use those funds, and realistic repayment plan, right? So you don't want to just have money in a panic and not be able to repay it. That's a bad thing. So financials first and foremost. We've talked a lot about these today, so I'm not going to go through this step by step, but those are those financial statements. They're typically going to ask for 2 to 3 years. If you're a new business, obviously you can't produce 2 to 3 years worth of financial statements, but you're going to lean heavily then on something called a business plan with projections, and you're going to be providing those. So they're going to analyze these to determine whether the business generates enough income or your idea or your plan is likely to generate enough income to cover those loan payments. Business tax returns, obviously, filing your business tax returns is extremely important. They're often going to ask for up to 3 years of those business tax returns. Again, if you're a new business, that's going to look a little different. You might not have those, but they're confirming your reported revenue on there, your expenses, your business activity, and your financial consistency. They're often used to determine or verify if those financial statements that you submitted are actually accurate or correct, right? Because we're creating those ourselves or someone else is, but there's a lot of things that can go sideways in those. And then your personal financial information. So if you own 20% or more of the business, then the lender is typically going to review your personal finances. And so those could be your personal tax returns, credit, your personal credit score, driver's license or ID, right? To determine if you're eligible for certain loans, and then also your resume or professional background, right? Are you qualified to run this business or operate or own this business? And they're going to review those personal finances because owners usually provide personal loan guarantees if it's an SBA backed loan. So there's different loans that have different requirements. And then your credit history, as I mentioned before, yes, this is very common that they are going to ask for your personal credit and review that as well. Business plan. I briefly spoke about a business plan. Business plans are obviously telling the story about the plan of the business, and these can be extremely important when it comes to lending and to be able to tell that story. Definitely, if you're a new business and you don't have all that financial data to stand on, as well as those accurate projections for what's going to happen within the business. If you do have that loan to add that piece of equipment, build that expansion, grow that line, whatever it may be. And for startups, as I mentioned before, these are extremely important because they do tell a story that doesn't exist yet. Business planning assistance can be part of this Accelerate Columbus program. So if you're thinking about growing and expanding, deploying any kind of capital, certainly then register for Accelerate Columbus and get the help that you need. Legal business documentation. So, how is the business structured? Do you have the appropriate business licenses, articles of incorporation, right? What percentage of the business does each person own? Do you have your EIN number? This is basic startup information, right? But they're also going to be asking for that. They want to make sure that the people that are, in charge of this business, one, are the ones that are authorizing the ability for the lending to happen, as well as, you can't just walk into a bank and ask for money, right? And not be able to substantiate or support the fact that you're part of it. And then debt and liability. So lenders want to understand your existing obligations, current business debt, loan statements, things of that nature. And then collateral. So maybe this loan is backed by some kind of collateral, or it's going to be backed by the collateral itself. So what are those assets that you might already have? And that helps reduce some risk. And then that banking history. So any kind of statements that are going to back up what you've got on that, on your financial data as well. So the next steps, obviously, if anybody has any questions, please go ahead and ask them. This is absolutely the appropriate time to do that. But next steps are here. I've got a QR code on the screen. So if you are not already registered for Accelerate Columbus, which I know some of you may be, or if you're not really sure if you even qualify for Accelerate Columbus, please don't be concerned. You can use this QR code, or if you want to just type in at the bottom, this is going to give you more information about the Accelerate Columbus program as far as how SBC is deploying it from that financial management standpoint. There is a short form that you can register for it. Our team will handle looking at your business as far as where is your business located, to ensure that you're within the city limits of City of Columbus. If you are not, because those lines can be kind of gray, I guess, in some places. I mean, one side of the street can be and the other side is not. Our team will know if it is or not, and they'll be able to give you that feedback. Remember, there is the opportunity from the scholarship standpoint that OSDC is offering as well. So if you are not, then they might be willing to help support that as well. So Miranda just asked, is there one in Cleveland too? I'm not sure about whether or not Cleveland has a program like Accelerate Columbus. There are certain resources up there as well. It looks like Heather is typing a response to Miranda, so she probably is talking from an OSDC standpoint. So that is also if you're not in City of Columbus, you might be eligible for one of those sponsorships from OSDC. So I would invite all of you to go ahead and fill out the form, register. If you don't want to fill out that form, you can certainly send me an email at info@sbcfirst.com. And that is, you could ask these questions. So if you're not sure about what resources are there, we can try to connect you with resources in that area. So Brandon, I'm just going to respond to you and say email me at info@sbcfirst.com. and then I can try to connect you with some of those resources. Karen?
And yeah, Brandon, if you could also just apply for the link here, even though you're out of the area, we can then direct you to either OSDC or some of the local resources in your area.
Yep. There's programs everywhere, which is why we say that we work on a national level, and so we have a lot of connections in different areas. So there might be a program that's available in your area that isn't Accelerate Columbus, right? If you happen to not be in that area, so we will do our best to connect you with someone as well, though. Any other questions? We've got about 5 minutes, so we are happy to answer any questions that anybody has. Otherwise, as I mentioned, I will send a copy of these slides to everyone who attended, so that way you have the information. This is also being recorded, and everyone that registered is going to receive the recording from Eventbrite once I've got it up on YouTube. So if there was anything in here that you want to go back and review, it's certainly there. But we do thank all of you for taking the time during your lunch hour today, if you're all on the East Coast, in order to join us and learn about these things. As far as the Accelerate Columbus program, we will have 2 additional workshops specific to Accelerate Columbus. The next one coming up is it in October, Karen? I don't remember off the top
Yes,
of my
I
head.
believe it is in October for nonprofits.
For nonprofit accounting
Yep.
specifically. And then there will be a 4th one in the 4th quarter that will be more geared towards for-profit again. And great program, as I mentioned. Check into it if you need help outside of finance. We can help you connect to those resources as well. Then we also have additional workshops from SBC Consulting, right? Because I mentioned there are programs throughout the country that we work with. And so if you're following us on Eventbrite, you're most likely going to see some of those upcoming workshops posted on there as well. So feel free to register for those if needed and get that additional help. Most of the programs are open to, especially if it's a webinar, right? And there's space for it. We can hold up to 500 people in our webinars. So as long as they don't sell out, then we are happy to have you there, and so that you can get the help that you need from a small business perspective. Brandon, I'm not sure I understand your question. Accelerate Ohio. I have one of those as well. So it's Accelerate Columbus because it's paid for by the city of Columbus, if that helps with the clarification. And we are grateful for the city of Columbus and their small business group for everything that they do in order to bring these resources to those small businesses within the city of Columbus. Thank you, Raven, who's joining us today from City of Columbus. Any other questions? We've got about 2 minutes. We hope to see you guys on the other side with that one-on-one consulting that I mentioned. So how that works, if you guys aren't familiar with one-on-one consulting, is that someone on the SBC team, there are quite a few of us. I didn't put up the slide of all of us with differing specialties. As far as our background, we are mostly all entrepreneurs who have probably owned a small business or still do own a small business at some point in our lives. Our consultants are either full-time doing consulting or part-time, depending on how much their business is pulling them in one direction. And so we've lived it, right? Some of us have lived it for 25 years or more. I owned my very first small business when I was 20. It was insane. I can tell you stories about what it was like to own a small business. I told you one of them, obviously owning a commercial contracting business in 2008, was a world I don't don't ever want to live in again. But it certainly came with its own challenges and lots of life experience. And we share those with everyone every single day. What we've done, and our whole goal is to help you overcome some of those challenges that we've learned or have seen in order to help you prevent some of the mistakes or maybe things that might be coming in the future. But financial management is definitely something our group is passionate about because it is so extremely important if you want to grow your business or stabilize your business. So it is 1 o'clock now, and I want to be able to make sure that you all get back to your lives. But thank you very much for joining us, and I hope to see all of you in the future. Feel free to connect with us on LinkedIn, and we'll talk more. So thank you all for joining. Bye-bye.